We are recording now. Everyone, thanks for joining. I'm Brian Bolton, finance professor at UL Lafayette. This is session 7 in our 15-part series for the UL system on financial wellness for the summer. Today's topic is family financial planning and caring for adult dependents. As we see throughout today's session, I'll use the word probably in general a lot. I'll use terms like that a lot. One of my cliches in this work is that personal finance is very personal, and probably no topic's more personal than caring for loved ones, caring for adult dependents. And so in some ways, I'll make this topic somewhat objective and maybe try to remove emotion and relationships out for the financial planning component, but always recognize, keep in your mind, I'm not just some cold finance guy. We're doing that so we can generalize and go through principles, policies, maybe best practices and things to think about. That's why I've dropped the deck in the slide deck in the chat, so you can kind of review that and identify what's relevant to you and certainly what's not relevant to you. So we'll do our best, and we'll cover a lot of ground, I think, both finance and maybe some non-finance issues, and at least get us thinking about it. So this is session 7. I'm Brian Bolton, finance professor. Please contact me, brian.bolton. Again, those of you in attendance, I will email you these materials afterwards. So you'll have my email. You can get my email relatively easily. I also have a website through the UL Lafayette platform, business.louisiana.edu/finances personal. That's more of a library or repository with slide decks like this, other workshops I've done, workbooks. I've got a couple or 3 books actually posted there. Feel free to download, feel free to share. And feel free, obviously, to follow up with questions. As I mentioned, this is part 7 of a 15-part series. This slide has kind of become my own personal advent calendar, counting down. We're 7 out of 15. We're about halfway. Today, we're talking about family financial planning. This is, I guess, the third of, I think we'll have 6 that are really focused on the family, but obviously most of these can be applied for family situations. We're taking next week off for July 4th, and then we'll be back here July 13th and 14th, maybe for two of my favorite topics, changing careers, and then kind of the base foundation of building savings. Welcome, Brittany. Glad you could join us. And so that's the series for the full summer. But as I mentioned, we've got kind of this 6-part focus on the family. We started last week with a real generic making finances work. We talked about loved ones, sending loved ones off to college yesterday. Today, we're doing kind of the other end of the life cycle, potentially caring for adult dependents. And then we'll have building savings, retirement, and then the fun stuff. We'll conclude at the end of the summer. So that's the series, that's the schedule. Again, all 15 of these sessions really are for the family, but these 6 are specific. And when we say family, obviously that term could mean just about anything, whatever you define it as, whatever it applies to you. I'm not going to define it. I don't really care. Yesterday when we did sending your loved ones off to college, we focused on kind of 16 to 18-year-old time frame. And today, just kind of think the generic framework we're thinking about is kind of maybe parents in their 30s, 40s, 50s, maybe children between 5 and 15, 20, and then adult dependent returning, whether that's grandpa, grandma, anything else. Basically, when we say adult dependent, it can mean just about anything. It does not have to even be a relative. Obviously could be a grandparent or an aunt or great aunt, uncle. Could be just about anything. I chose this kind of general family picture, I guess, because maybe it's the most common. I don't know. But it also, looking at 3 generations, we've got different priorities, and having 3 generations represented, it kind of forces us to have different priorities and look at things in different ways. But again, this, the focus will be kind of on mom and dad with grandma, grandpa, the adult elder generation coming back to the family or to the household, I guess. And so that's the focus. Again, create whatever focus you want. My bias as we go through this is that financial transparency is a good thing. Having these conversations, we'll talk about 5 kind of themes, and what the first will be communication. I'm a big fan of having conversations, having uncomfortable conversations, if it needs to be, because having uncomfortable conversations is usually better than dealing with the discomfort of not having those conversations, and having surprises or expectations or assumptions. And certainly yesterday when we talked about sending loved ones off to college, you want to make sure your 16, 18, 20-year-old knows what the financial relationship is going to be going forward. And I think with adult dependents returning to the nest, it's just as important. And just having that communication about financial responsibilities, obligations, and relationships. I think if I had another bias, it would be that the relationships always should dominate money, but you want to make sure that the money doesn't compromise the relationships. And maybe the best place to start with that is communication and financial transparency. So that's my bias. That's my framework. Obviously, every family is going to have different communication behaviors and habits. But sometimes these uncomfortable conversations need to be had to avoid greater discomfort down the line. So I mentioned the themes, communication, we'll start with that. We'll go into taxes. There are some significant tax issues related to caring for adult dependents. And then we'll kind of do just a general financial planning. I've identified 2 or 3 issues that maybe are unique to adult dependents. All of the kind of base foundational financial planning, start with goals, values, dreams, look at where you are, think about how you're going to get there. All of the budgeting, investing, all of those things apply to just about any relationship, and certainly caring for adult dependents. So I'm not going to spend a lot of time on those frameworks. But I've tried to identify the money issues that maybe are unique to this relationship. And I'll go into insurance probably more than I usually would, because as we get older, we have different and unique insurance needs. And if the children are caring for the adult dependents, they certainly need to be involved in insurance decisions or policies. And then the final section, I didn't really know what to call this, but I'm calling it the final transition, when adult dependents pass on, and thinking about kind of either preparations or financial or logistical issues in that transition. So that's where we're going. Let's start with communication. Again, my bias, more transparency is good. Talking earlier is better. And what does that mean? Does it mean, you can decide if, when you're in your 30s or 40s, if you're talking to your 65-year-old independent, active, healthy parents about what happens next. My parents are, what are they, mid-70s. I'm the youngest of 3 kids. My sisters and I have had that conversation. Parents are healthy, independent. Fortunately, they live about a mile away from my oldest sister. So we have good communication and good interaction. And earlier the better on the communication, just so everyone knows what to expect. But it's also not just about the adult dependents. It's about maybe other children. If you have a 10 or 12-year-old at home and grandma and grandpa are moving in, their lives going to be disrupted. So make sure you talk with them, make sure they understand, whether they're losing the room, or maybe there's financial compromises, financial sacrifices. Maybe college choices will be impacted as we care for adult dependents. Whatever issues you think are going to arise from this relationship, make sure we have those conversations sooner rather than later. If your children are 10 or 12, maybe you don't have the in-depth conversation you would with a 16 or 18-year-old. They probably need to be involved. And if you are one of several siblings, you want to talk to them too. And I've seen it in too many families where expectations and lack of communication between siblings, 40, 50-year-old siblings caring for parents, destroys relationships and creates far too much dysfunction and tension and unnecessary problems within the family. So having those conversations open and transparent, either about who's taken care of financially or with healthcare, the sooner the better on those conversations too. And again, all of these conversations might be uncomfortable, but they're probably better. That discomfort's probably better than other discomfort. Maybe the easiest conversations are actually with the adult dependents, because at a certain point, maybe they're going to be stubborn and not accept that they need help for a while, but eventually, once they do need help, they're probably going to appreciate it. So the earlier the better. And then thinking about just these conversations, again, maybe when they're in their 60s and healthy and active and independent, you begin thinking about where they're going to live. Who's responsible for finances? Do you commingle? Meaning, do you move mom's bank account into your own? What other needs, social, medical, transportation, other needs are they going to have? And then what is their wish with the timing? Obviously, you can't plan out maybe the last 10, 15 years of someone's life, what their needs will be, but you can begin thinking about it. Maybe mom absolutely positively never wants to go to a senior living center. Maybe dad does. And just having those conversations about what they need, having conversations with your siblings about whether you are emotionally and logistically prepared to care. Can you, bring in your 75-year-old parents and take care of their kind of day-to-day, maintenance needs and healthcare needs or whatever. And if you have 5 kids of your own at the house, maybe you can't. And so having that conversation and just being clear that we will need specialized long-term care. We will need a facility we will need mom or dad to go to an independent facility. No matter how much we love them and want to care for them, it may not be in the best interest of all. So communication, the earlier the better. There's going to be difficult conversations. Do they have life insurance? That might not be the most difficult. We'll return to that in the insurance section. Thinking about wills, living wills, durable power of attorney, medical directives, all of these kind of different legal documents that can provide guidance that in theory should take precedent over just informal communication conversations. Again, we'll return to those in the final section. We'll talk about trusts a little bit more and income streams in the money section, the middle section today. I've seen far too many times when seniors, as they age and maybe lose their faculties, they also lose track of different income streams or even different debts and obligations. And so the earlier you can have those conversations and do that inventory, the better things are going to be when it becomes time for the younger generations to get involved. And then independence and independence and dependence are they're states of mind, obviously, and states of heart, but they're also legal definitions and for the IRS. And so we'll look at the definition in the next slide. But thinking about independence legally, your siblings may want to have that conversation with the adult dependents to just to confirm kind of the tax reporting and any other legal issues. Again, the point is that we hear the term dependents, we think we think children, but your 60, 70, 80-year-old parents can legally be dependent as well. And they can be legally dependents for tax purposes too. In general, told you I'd use that term quite a bit today. In general, an adult dependent is legally a dependent if you provide more than 50% of their living support for the year, and they have less than $4,400 in gross income for the year. There's exceptions, there's fine print, Social Security receipts can change that $4,400. They may have passive income from investments that's not earned income that may change that. That is the general guideline. And so many of our parents may not qualify as a dependent for tax purposes because they may have more than $4,400 in Social Security income or a pension or something else. But if they have less than that and you provide more than 50% of their support, legally you can claim them as a dependent on your tax return. They may still want to file their own independent tax return, even if you're claiming them as a dependent. That's legal. You can do that. The reason they would do that is just to report, one, they have this amount of income. They have a certain amount of income. The IRS really likes it if you have income that you tell them, even if it's $2,000. So one, to report to them, and also to report to the IRS, hey, my children are claiming me as a dependent. So exceptions in fine print, but that's basically the starting point for whether or not you can claim an adult dependent as a technical dependent on your taxes. And if we can, what does that mean? Or sorry. In general, if your adult dependent is still married and they are filing jointly with their spouse, you cannot claim them, regardless of income, regardless of support. If they're filing jointly, the assumption is they're mutually dependent on their spouses, right? Mom is, if you think mom is your dependent, as long as mom still has, dad around, dad is taking care of her. So that's the assumption. So if they're filing jointly, the spouses are generally mutually dependent. The children do not get to claim, children or no one else gets to claim them as dependents. But what if we do? You would include their tax income information, meaning their income. You would add it into your tax information. You also can potentially benefit from any deductions, whether those itemized deductions or certainly medical expenses. Once you include them as a dependent, you may be eligible for deductions and credits. And I use this hedging language. You may be, just depending on your situation. Most of us, if we have adult dependents, will be eligible for potentially 2 or 3 of these, if not all 4. Earned income tax credit, generally reserved for lower income tax filers. And so if you are lower income, below, well below the median, just above poverty line, you're eligible for an earned income tax credit. You get additional tax credit for taking care of more dependents. There's a tax credit for other dependents. So the other implies other than children. And I believe that's $500 per dependent. There's a child and dependent care credit for any and all children and dependents, and the key word there is the care. So whether that's daycare or nursing or whatever care we provide for our dependents, we are eligible for a credit there. And then there's a deduction for medical expenses. I call it above the line. I'll show you what that means in the next couple of slides. Perhaps the key out of this is if you're of a certain age, maybe, I don't know, 35 or older, you probably got used to claiming the number of dependents as deductions. That changed in 2017, 2017 tax cuts into 2018. We no longer get individual deductions just by the number of dependents that we have, but they've expanded the standard deduction, they've expanded the number of credits. I don't know if it's a wash. I don't know if it's a loss or a benefit for some people, but there's been that change, right? So 10 years ago, if you had 10 children, you would get a deduction for each of the 10 children. No longer, but those 10 children may help you get different tax credits, certainly. With our adult dependents, the deductions for medical expenses can be a really beneficial one. I say that's above the line. Let me show you what that means. This is our basic 1040. So when we file taxes, it looks something like this. This is obviously a very easy 1040. We get our gross salary and wages from work or from a 1099. We have some medical expenses. We have contributions to retirement accounts. Both of those, and this is you with your contributions to your retirement account or your own medical expenses or medical expenses for an adult dependent. We subtract that from salary and wages. That when I say above the line, that's what this means. We use that to get to adjusted gross income. And then each of us takes either the standard deduction, it's about $14,000 for individuals, or about $29,000 for married filing jointly. Or if we itemize deductions through home mortgage interest, donations, and other items, we can subtract that. So we subtract that standard or itemized deduction from our adjusted gross income to get to taxable income, apply our tax rate, we'll get to a gross taxes owed, and we'll subtract off tax credits. I go through this math in this table to kind of emphasize how do the adult dependents help our tax situation. And it's going to be in these two primary areas. One, the medical expenses, whatever they are, we get to reduce them. We get to reduce our gross salary by that amount. Maybe not dollar for dollar, but in some cases it will be dollar for dollar. And again, whether we incur those for ourselves or for adult dependents, if we're taking care of them, they count towards our tax obligations. And so the nice thing about the above the line, the reason I emphasize the above the line, and I don't have a graphic here on my slide, is because of the standard deduction. We get both, right? So your home mortgage interest, if your home mortgage interest is $1,000 this year, we include that in itemized deduction category. You're not automatically taking that because that's going to be less than your standard deduction. With medical expenses and contributions to retirement accounts, we get to reduce our income by that, and we get to take the standard deduction. So the above the line deductions are the second best type of deduction or credit. The best type is the credit. And so the tax credits we have down here at the bottom, once we calculate gross taxes owed, we can reduce the gross taxes owed dollar for dollar by these tax credits. So when I said, this tax credit for other dependents, I believe it's $500 per other dependent. Once we calculate what our gross taxes owed are, we subtract $500 as a tax credit. And you can have multiple tax credits. Some tax credits are what we call refundable. Others are non-refundable. Non-refundable means, let's say your gross taxes owed is $300 and you get this credit for other dependents of $500. So you owe $300, you get a credit for $500. That looks like, maybe it sounds like you should be getting $200 refund. If it's a non-refundable credit, you don't get that, right? You get the maximum. The maximum would be a zero, right? They're not going to send you a check for a credit, for a non-refundable credit. If it's a refundable credit, and the earned income tax credit is a refundable credit, you get, if you owe $300, the tax credit's $500, you get $200 check from the government. So adult dependents can help us in a variety of ways there. Obviously, we are spending money to care for them. They're spending money to care for themselves. But by keeping our receipts, by tracking, kind of understanding where the tax responsibilities and opportunities are, we can reduce the taxes owed. So let's talk about money. I think the first question to answer is who's going to be responsible? And do you commingle your taxes with theirs? Do you commingle accounts? What is the role with other family members who may be involved? Are there certain family members who are better with budgeting and finances and just that kind of responsibility? I look at my mom's family. They have 5 family members between 68 and 78 years old, and for 20 years, my oldest aunt, my second oldest aunt, my oldest aunt Sue has been handling the entire family's finances, and everyone is okay with that. But she's not providing the care; she's just doing the finances. And so your family will figure it out. In many ways, it may be best not to commingle accounts, just to keep budgets and obligations independent and straightforward. But someone, in my example, it's my Aunt Sue, my mom's family's example, it's my Aunt Sue. Someone needs either the power of attorney. Power of attorneys is what the adult dependent gives to the child or anyone else to have decision-making authority over all life decisions should the adult dependent not be able to make their own decisions, either through mental incapacitation, physical incapacitation, or illness or otherwise. So power of attorney gives basically full decision-making authority over life decisions, including finances. Power of appointment is just decision-making over assets and finances. So power of attorney, you might be able to make choices about healthcare, some choices about healthcare, kind of generic healthcare. We'll talk about a living will in just a second. Where they live and otherwise. Power of appointment, you might not have that much authority, but you would have the authority to pay bills, to take out loans, to collect income on behalf of the adult dependent. So maybe I should have put this under communication, right? You want to have this communication about who is the power of attorney for the adult dependents, who, if anyone, has power of appointment. If you have power of attorney, you may not need power of appointment, but you may prefer to have a power of appointment so that that person only has authority over the financials. And I said earlier that I wanted to throw in some maybe non-traditional caretaking ideas about money. Trusts are not just for the super wealthy. You hear the term trusts, or I hear the term trust, I immediately think of trust fund babies and kids and the super wealthy. But as I've gotten into this work, I realize that even if you have $100, maybe it's 1,000, right? You maybe need a certain amount because trusts are not free, but you can set up a trust as a really effective way to, I said transfer, but it also just could be to manage assets during life and or outside of a will. Explain the benefits of both those in just a second. So an example, my elderly mom moves in with me. Let's say she has $100,000 in savings. She's no longer comfortable managing it. She also doesn't want to burden me maybe with the management, or I don't want to, or I'm not qualified. She intends to live off the savings or that 100,000 for the rest of her life, and I'll help as I can or whatever. But if she has any left over of the 100,000, she wants to give it to me when she passes. One answer or one approach is just to keep the 100,000 in the savings and do with it as you will, and then as we normally do, during our professional years or younger years, and then let me inherit the remainder through the will. Perhaps a more efficient way is she can put the full 100,000 into, I said irrevocable, could also be revocable. Irrevocable means she legally transfers it out of her name. Revocable, she can take it back anytime. The practical differences are minor. The legal differences only matter if you've got enormous estates, 13 million or more. So let's say she puts the 100,000 into a trust, withdraws a certain amount periodically. There is an independent trust manager, not me, not mom, who manages the assets. We will choose who that is. It's probably a banker, a lawyer, someone, our bank or our financial institutions or lawyer can identify trust managers. We will pay them a small fee, 1%, 2%, 3% per year. So the trusts aren't free. We tell them what the rules are, what the policy is. Trusts are enormously flexible. You can structure them just about however you want. And mom lives off the income. The banker or the lawyer gives her the income. I'm the ultimate beneficiary. I'm in line. I get the remainder whenever mom passes. The nice thing about trust is everything happens outside of a will. So the moment mom dies, immediately, as soon as she dies, the remaining money legally becomes mine. And that's because I am the remainder beneficiary of the trust. The key word is beneficiary. You might have beneficiaries on your retirement plans, same thing, right? So your IRA, 403B, 401k, if you have a retirement plan, you can name a legal beneficiary. If you haven't done that, I encourage you to do that. And the really great thing about beneficiaries is the money goes immediately to the beneficiary the moment you die. I say moment. It should take at most a couple hours for the financial institution to affect that change. It will not take weeks. With a will, it could actually take months. If mom leaves me, Brian inherits the remainder of my 100,000 after I pass. If she says that in her will, it could take months. We're paying court fees, we're paying legal fees that could be anywhere from 5 to 15% of the balance. And as I'll talk about in the final slides, that could be contested. Whereas trusts generally cannot be contested because we've got this kind of independent trust manager managing it. The point is, trusts are not for the super wealthy. They're effective ways to transfer assets, to manage assets, keep assets outside of a will. But they're also just super transparent and efficient ways to kind of protect assets as well. So how does this event, moving on from trust, how does this event affect money available and financial planning for other family members like children? Does it, as I mentioned at the beginning, is this going to affect whether your 10 and 12-year-old go to the private college, or maybe they have to go to a state university? We have 9 very good universities in the UL system to choose from. And so, how does that affect things? Is there going to be logistical issues at home? As you're thinking about mom and dad, talk about mom moving back in, At what point do you sell mom's assets, the house, the car, anything that will not be kept in the family via the will or other trusts? Maybe you put everything in storage for a while. That's going to be costly as well. And so just thinking about during this transition period, if you want to call it that, how you manage the assets that have been maybe near and dear to mom or dad's, heart for their lives. Transition happens and change happens, and just begin thinking about who manages that. What do you do with the money from that? And then financially, at what point do you consider senior living facility or assisted care? As you may know, there are dozens of levels of facilities that provide. Some just provide housing, basically housing and food. Others provide round-the-clock medical care. The more intense the medical care, the more expensive. Most of these facilities start at around $2,500 or $3,000 for a 12 by 12, 12 by 15 room, private room. If mom and dad are moving in together, obviously it'd be about the same price, maybe a little more because they only have one room or one suite, but maybe twice as many meals. You can get up to 10 to 12, 15,000 per month pretty quickly, especially if the medical needs are greater. In general, health insurance does not cover assisted living. Health insurance, long-term care, health insurance is designed to cover the healthcare, but not the housing. And so if you have medical needs at the facility, health insurance may cover that, but not the housing and not the room and board. Long-term care disability insurance, I'll talk about that in a second, may cover assisted living, but only if you chose for it to cover assisted living when you acquired the policy. So when you get the policy, you get to choose, will this cover assisted living? And you get to choose. Medicare, Medicaid, VA benefits generally do not cover room and board. Like your health insurance, they generally only cover the health or medical needs. So that room and board of assisted living or assisted care living facility, one, it gets pretty pricey, and two, you may not have coverage through insurance or other means. As we talked about earlier in the taxes, these costs are generally tax deductible. Whatever medical costs you have, you're caring for mom or dad if they are dependent. So looking into that, thinking about that is critical. Understanding the costs is critical. And as we think about this, let's move into insurance. We'll go through several types of insurance. The rule of insurance, all types of insurance. The paradox is you want to buy it before you need it. But if you buy it before you need it, you feel like you're paying for something you don't need yet. And as our parents get older, as we get older, the inevitability of healthcare or potentially death or all that happens at the end of our lives, the inevitability is real, and insurance provides different ways to protect for it. So health insurance for adult dependents, Medicare kicks in at age 65. Medicaid can kick in younger for lower income families. Once the adults are eligible, that may be sufficient health insurance for them. So you may not need additional health care if they're eligible for Medicare, Medicaid, or VA benefits. In general, it can be difficult to move an adult dependent onto a family's health plan. So my health plan here at UL, if mom were to move into me, it might be difficult for me to add her to my policy. I can add just about as many children as I want. It's difficult. In some policies, I may not be allowed to add adult dependents. And so they would need their own independent healthcare, either through Medicaid, Medicare, VA benefits, or they would need to go to the private market. And obviously, as we all get older, our health needs increase. And so you want to make sure that the adult dependents have care coverage in some way. On the other hand, property casualty liability insurance, for cars and physical assets, we can add them pretty easily, especially if they're moving in with us. If mom and dad are 2 miles away, maybe we need separate policies, or it's a little more difficult to commingle policies. But if mom or dad move back in with us or someone else, we can generally add their assets and their their needs to our policies. If they bring significant assets, whether it's jewelry or antiques or whatever else that are significantly more than my coverage, if my coverage is 200,000, mom's bringing 300,000 of jewelry and antiques, I would want to change my policy. But those are relatively simple changes, whereas the health insurance changes are less simple. So those are the common, straightforward types of insurance. Few types of maybe less common, but certainly necessary as we get older. If you're buying life insurance for elderly adult dependents, 60, 65 plus, it's probably going to be very expensive because the probability of needing, or let me rephrase that, the probability of a claim on life insurance gets higher and higher as we get older, perhaps obviously. If, let's say, dad dies, mom receives life insurance from dad, mom has that income, those proceeds may or may not be taxable. They're generally only most likely to be taxable if they were provided by an employer and in the amount of over 50,000. If the amount is under 50,000 provided by an employer, you both already paid for it, and you both already paid after taxes. So it's not going to, you get a check, a life insurance check for 50,000 through your employer policy, 99% chance it is not taxable. If you get a check from an independent policy that you purchased outside of your employer, it's probably not taxable. The proceeds are probably not taxable. You used your after-tax savings or money to buy that policy because it's already after tax. They can't hit you with tax again. So think about getting it. Again, we want to get these things before we need them, in part because the price is better. And the terms are going to be more flexible, and you don't obviously run the risk of dying before you have it. Annuities are frequently thought of as an alternative life insurance, and they are. But it kind of works in the reverse. Instead of paying $50 or $100 a month to get life insurance, one big lump sum at the end of life, it's kind of reversed. I would pay a large lump sum today, or my mom would, and then we get regular, smaller, periodic payments throughout the life. So let's go back to mom moving in with me. She still has this $100 in savings. Instead of setting up the trust we talked about earlier, takes that $100, she buys an annuity, takes that 100,000 to New York Life or John Hancock or some life insurance company. They'll set up the annuity, and all they're really doing is taking that 100,000 and then slicing it up and giving mom cash each year as a portion of that 100,000. The annuity, the word is derived from the word annual. And so they're paying her periodic payments. It may not be 8,000 a year. It might be 600 a month or whatever we arrange, but you're getting these periodic payments. Annuities are not free. They're not going to charge you a big price necessarily. It won't look like they're charging you explicitly, but they're taking their cut on the backside. They're going to take mom's 100,000. They're going to invest it in stocks and bonds, pool it with millions or billions of other dollars of investments. They're going to generate an 8 or 9% return. They're going to pay mom 7 or 8% return, and they're going to keep that spread, that 1, 2, 3% return. The really big benefit of annuities is not the profits, it's the regular fixed income. If mom has the 100,000, she may have difficulty managing that appropriately, budgeting that appropriately. Whereas if mom receives $8,000 a year until she dies, then it's much more easy for her to manage $8,000 a year rather than a big pool of 100,000. When we do the math, the kind of rule of thumb is if mom lives longer than expected, and when I say expected, I mean as expected by the insurance company that priced this and sold this to her. If she lives longer than expected, it can be a good thing. If she dies earlier than expected, it's obviously a bad thing, right? If she pays 100,000 and then gets 3 checks for 8,000 before she dies, it's a bad deal. Where if she pays 100,000 and gets 30 checks of 8,000, maybe it's a good deal. That's the simple math. One of the downsides to annuities is they cannot be inherited. Once mom dies, policy's over. Whereas if mom had kept the 100,000 in savings, whatever she doesn't spend, she can give to me. Some policies, both life insurance and annuities, will see characterized as survivorship or second to die policies. If it's an insurance policy, it only pays out once the second partner to the policy dies. Whereas with an annuity, the policy pays out until both policyholders pass. And so paying attention to this wording is critical. I'm going to speed up as I'm looking at the clock, as we want to get through the insurance and the final transition. So life insurance annuities are ways to create cash flows, or either in one large lump sum with life insurance or in periodic payments with annuities. Great things to consider. Long-term care. How do you pay for end-of-life needs or last quarter of life needs? As I said earlier, most healthcare will not pay for living facilities, but long-term care insurance can be a way to do it. Went on AARP this morning and saw that more than people over 70 years old file more than 95% of long-term care insurance claims. The average age of making a claim is 79. So these are not policies for the young. They are policies for that last quarter of our life. Probably the best time to acquire long-term care insurance is probably between 60 and 65, maybe depending on your health. If you're super healthy, maybe 65. If you have other needs, maybe 60. And the reason is you don't want to spend 10 or 15 years paying before you get any benefits. But you also don't want to wait too long when the premiums might be exorbitant. Rates per year at 60, 65 can be 3,000 to 4,000. If you wait until 70, maybe you're looking at 7,000 or 8,000 a year. This will cover all long-term costs that health insurance, Medicare, Medicaid, VA benefits do not cover, like room and board, cost of assisted living, can handle transportation, obviously food, that's board, and other needs. Caveat is, if your adult dependent is going to be down the hall in your guest room or in their old room, this may not be necessary, or you may need a smaller policy. You can maybe save some money because you will be providing that long-term care. And so having the independent facility do it is not necessary. You may have heard of the term disability insurance. Disability insurance is not really disability insurance. It's actually income insurance, and it's not really just for elderly or disabled. It's something we could have, any of us could have in our 20s, 30s, 40s, and it just protects our income, a cash flow stream, in the event of I'm unable to work. It's not necessarily a disability, it just could be an injury, a car crash, not necessarily a long-term or permanent disability. With disability insurance, you get to choose the amount of coverage, you choose the length of coverage, you choose the waiting period or the rehabilitation or the type. You may have heard of disability. I mentioned it here because you probably don't need it for your adult dependents. You probably don't need it unless they're still working and active working. That income is a big part of their financial planning and their cash flow. Long-term care coverage will likely take care of all they need, and you probably don't need disability, again, unless they're working and that's their cash flow. Moving on to the final transition, we talked about durable power of attorney for making all life decisions, living will for making healthcare decisions, the proverbial pulling the plug that is outlined in living will. We need to come up with a more sensitive way to refer to that. But you know what I mean, right? Making those kind of end of life healthcare major decisions. That is who does that, and what our adult dependents' priorities or preferences are will be outlined in the living will. We also need to have a will. Mention that in just a second. And then kind of thinking about those transitions or those final days, do you move home to spend the final days with the family, or do you want that the end to happen in either assisted living or hospital or some other? So thinking about that, thinking about having those conversations. These are all 5 of these are conversations we should probably have with our family members and loved ones. Maybe not immediately, but eventually, certainly once transitions are beginning. Everyone needs a will. If you don't have a will, get one. And whether you're a 75-year-old adult dependent or a 35-year-old healthy, active professional, you probably need a will. And if you don't have a will, we call that intestate, and it just basically means the state will decide who gets your stuff. And even if you don't have a lot of stuff, you have obligations, you have debt, maybe you have a house, you have a car. A will is you can get a will for $300, $400, $500 online. You can go to a lawyer and get one for $1,500. It just outlines that transition. I mentioned the word beneficiary earlier. Anything with a beneficiary, retirement plan, life insurance, trust, those take precedence over a will. So if we have beneficiaries, that's automatic. The will address everything else. Two problems with wills. Wills can be contested. Wills can be contested. I mentioned, you probably heard the term being of sound mind and body, that phrase that we think every will starts with. You can contest whether or not the author of the will, the individual, was of sound mind when they wrote the will. And if you think of, modern families that maybe multiple divorces, multiple marriages, multiple relationships, kids, maybe there's businesses, ex-business partners, as our financial and family situations get more complex, the chance of a will being contested is greater. And so that's why I mentioned earlier the trusts. Trusts are really difficult to contest, but wills are better than nothing. If you write a will when you're in your 40s or 50s and it's relatively clean and straightforward, chances of it being contested are pretty slim. And then the process of executing the will, it is a process. We go through probate. That's the will process. It can take a long time, making anywhere from 3 to 6 months, depending on the state, depending on the courts, and it can be expensive. Again, anywhere from 5 to 15% of the total assets. If the deceased does not have a will, the state will control the process, which means they'll take longer and maybe more expensive. But I suppose the good news is the family members will get most of the assets. Right? If you die and your parents are alive, most states the parents get it. If you die and your parents aren't alive, but you have children, the children get it. So you'll generally get your wishes, but it may take a long time. And then when the adult dependent passes, what happens? So the trust or will sign legal transfer. Any assets with identified beneficiaries, retirement, life insurance, trust will automatically pass. I hear too many stories of people not having money to pay for funeral and related services. Life insurance at a minimum can pay for this. If you have life insurance through work, it's probably $50,000 at least that should pay for at least most of a funeral related services. Those services are obviously very important to many people. And so we want to make sure that we have the financial means to do that. It may be an afterthought, but to execute most of what happens after an adult dependent passes, we need a certificate of death. We just file that with the county or parish or state. Typically costs $25 to $50, depending on the state, but we have to have it before just about anything else can be legally transferred. And then somebody has to manage the estate. You hear the word estate, you may think super wealthy, not necessarily. Even bankrupt and super poor people, it's still an estate, because somebody has to pay their bills and pay off their debt. Somebody has to take over the house, the vehicle, the other stuff. And if that's you at least want to have a process in place or a conversation in place for how that happens. The good problem to have is if the deceased is super wealthy and the estate is over 13 million, then we get some more complicated decisions in order to minimize estate taxes. We're not talking about that today. That's a good problem for another time. But whole specialization in minimizing estate taxes once you're in that problem. Very good problem to have. We talk about financial planning. We start with values, dreams, and goals. We look at our situation. How do we get where we want? We design the financial plan to help us get there. Today, we've talked about the family. We've talked about adult dependence. These relationships and these relationships and these decisions impact just about everything else we do, right? We know that. One thing I've been preaching these last few sessions as we're talking about the family is create individual financial plans for every family member. We've got the values, dreams, goals. We've got the current situation, but every family member, from our 10 and 12-year-old children wanting to go to camp or college to our 60 and 70-year-old parents needing care and needing socialization and relationships, we all need financial plans. And you can create kind of one umbrella family financial plan, but each of us is going to have our individual needs and goals. And so be specific, be intentional. We're all trying to achieve happiness. We've got this mix of short-term and long-term goals, and specifically with adult dependence, we've got very long-term goals and dynamics. Got very important family needs that will have significant financial needs. The more we can plan, the more we can plan ahead, the more control we can have over these dynamics, these situations, help us achieve this happiness. I'll go through, let's skip over these, but a goal without a plan is just a dream, cannot escape the responsibility of tomorrow by avoiding it today. Maybe that's the best quote for caring for adult dependents. Have the conversation, have those difficult conversations, get everything aligned, get everything in place. So well before mom, dad, or our loved ones need it, so that when they do need it, everything is automatic and relatively efficient. Times change, things change. Wash, rinse, repeat. Right? Set our goals, analyze the situation, create a plan, execute a plan. But you're always going to be adjusting the plan. And mom and dad, by the time they move in, they may change their desires 10 or 15 times, or they may change it every month or every year. That's okay. They're entitled. But we want to respond to that. We want to change our plans accordingly. That's it for this week. We did loved ones off to college yesterday. We did caring for adult dependents today. We're going to take a couple weeks off and come back with careers, and then we'll return to family financial planning. These slides will be posted. I have a one-pager, and the video will be posted. I'm Brian.Bolton, Louisiana. I'll send each of you, write your name down, Brittany. I'll send each of you this deck and the one-pager once we have it. Thanks for joining. I'm going to stop sharing and stop recording. And